Morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Chouhan. You're watching Indian Open. Bhai Dooj wishes to everybody across the country. Let's go straight to the headlines. The US Federal Reserve keeps interest rates unchanged at its November meeting, but a rate hike in December is firmly in the picture. The US midterm polls saw Democrats gain control of the House while Republicans managed to hold on to the Senate. The Organization of Petroleum Exporting Countries may go back to production cuts next year as oil prices falter amidst rising shale output in the US. And the Union Cabinet has approved selling all of the government stake in Dredging Corporation of India to a consortium of 4 ports. And a clutch up for the newsmakers as well, but none more so than what's happening on the global front. Let's first start off with the Fmc decision, and I'll dwell a little bit on each of these pieces before we dwell in greater detail with pieces coming in from the Bloomberg Global News studios as well. The Fmc decision, the US Fed stays on course for a hike in December. That it did what it did overnight is not of consequence, but frankly, the statements laid out that they are on course for a rate hike in December, and Fed acknowledged the drop in unemployment rate, repeated the outlook for further gradual rate increases. We'll talk more about this, but this is essentially the big development that happened overnight. Now, what's happened in the US markets over the 2-day period? I'll use the 2-day period because yesterday was a holiday for us. The US markets were stable after a strong session on Wednesday. They're spurred by a narrative that checks and balances present a positive move for the US markets. The fact that there will be checks and balances on the US president from the Republican side would only augur well for the markets. At least that's what the equity watchers felt day before yesterday. In yesterday's session, the markets did okay for themselves, and there is frankly a bit of a rally that is coming into the US markets over the last 3 days or this week as well after the pause that we saw yesterday. Frankly, because of that pause and because of the US, what the US markets did yesterday, the Asian markets have started off rather cautiously. So if you look at what the US markets did in trade yesterday specifically, or what the Asian markets are doing today, you would feel that there is a bit of a pause there. But frankly, yesterday there was a bit of a rally, today there's a bit of a pullback. So net, we are even Stevens. The Nikkei looks like starting off about 1/3% lower, or in fact 2/3% lower. The Hang Seng down about 2%, Shanghai down about 1%, the SGX Nifty indicating a start which might be marginally off in the session today. But the big news that might actually spur India in particular is crude, and the fact that it is now trading close to the $70 a barrel mark, and with the recent correction is now entered that definition of the bear market territory, down about 20% from the recent highs, and that augurs very, very well for somebody who is looking at India top down. The macros look positive. So I wouldn't be surprised if there's a brief bit of a pullback in the currency as well today. It is not apples to apples, but there might be a bit of a pullback in the currency as well today. But crude prices falling down definitely augurs well for our markets. How did we do in trade the last couple of days? And I'm kind of ignoring the Murat trading session because it's a very low volume session. But frankly, if you just look at what happened day before yesterday and the existing positions, the 10,600 put option has now seen active interest. That was the one that was trading very actively in the recently concluded trading range. But the range firmly still remains between 10,000 to about 11,000 odd levels. And of course, as I said, the oil price cut bodes really well for the near-term sentiment. We had the fag end of the results season as well, and not too many companies coming out with results, but Titan would be the nifty name to watch out for. Frankly, in terms of results, I think there's a lot more beyond Titan, which is important to monitor today. So Amara Raja Batteries, very important set of numbers. EID Parry, because of all that's happening in the sugar space, this one draws active interest from blue-blooded investors, people who've been in the markets for a number of decades. EID Parry remains a firm favorite, very important numbers to monitor. India Cements, after what N. Srinivasan told us in the recently concluded interaction that people are just gobbling up cement, that Indian Bank, Sobha Developers, Shankara Building Products, a clutch of important numbers to watch out for in the session today. However, that is during the course of the day. What will happen at 9:15? 3 or 4 stocks that I thought were important to monitor. Bharti Airtel, Moody's has placed the rating on review for a downgrade. They've cited how levels of profitability, low levels of profitability and expectations of weak cash flow might bring about some changes in ratings. Do watch out for Bharti Airtel, might react a little bit in the session today. The Economic Times is saying that car makers are planning to a longer planned shutdown schedule in order to reduce inventories. So watch out for the Marutis, the M&Ms and the others. These one would be important ones to monitor. Allahabad Bank will receive about 3,000 odd crores from the government via preferential issue. Let's see if this one reacts. And Jefferies has come out with a note on Voltas. Actually, a lot of brokerages have. I'm just using Jefferies as an example. They've cut the target price. They believe, the management indications of H1 margins of 11% representative for FY19 is something that I think a lot of brokerages are taking note of. However, what's lined up on First Word today? The recent jitters in the financial markets and a cryptic president hasn't deterred the US Federal Reserve from staying on its rate hike trajectory. So what does that mean for global equities? We speak to Andrew Freris and Hans Goethe. The recent drop in crude prices has prompted the OPEC to go back to a drawing board, this time to evaluate if it warrants a production cut next year. We develop on that for a bit. Agam then joins in to talk about the Nifty earning of the day, which is Titan. And then I take you through the 5 key lessons out of the 10 key ones that I thought were the most important in Samvat 2074. However, I'll start off with the big news. The Federal Open Market Committee left interest rates unchanged in its first meeting since October's market turmoil and this week's midterm elections. But that means that the Fed's on course to hike rates in December. Bloomberg's Kathleen Hayes has this report.
At the November meeting, nothing was expected from the Fed. And a big reason why, of course, no press conference. When there's no press conference, it's become the Fed's way under Ben Bernanke and Janet Yellen not to make any rate changes. Wait till there's one next year. Press conference at every meeting. Good move, Jay Powell. Glad you put that in place. But as for today, they did tweak their assessment a bit of the economy, but they did leave clearly in place this idea that they're going to move. Dots go. That's what we got in September when they updated their summary of economic projections. And over here you see 12 lined up, 12 out of a total of 16, signaling 4 rate hikes this year. Well, they didn't move today, so they've got to move in December. Let's take a look at those tweaks because they were pretty minor. So if anybody tells you about tweaks, don't worry, it didn't change anything. Business investment, after having looked strong to the Fed, is moderated from a rapid pace. It certainly did. That's just reflecting reality. Household spending has continued to grow strongly. That's good. They said the unemployment rate has declined, pointing out that it has. Instead, they said it remained low. Overall, though, the economy is rising at a strong rate. Again, that underscores this sense for the Fed that they're going to move. Risks are roughly balanced. If something changes, I suppose they could slow down. But right now, it seems like it would take something pretty big for them not to move.
Well, midterms, Fed, crude, what does all of this mean for the global financial markets that are already under a bit of a corrective mode? Let's ask Andrew Freris. He's CEO of Ecognosis Advisory Services, who joins us right now on the phone line from Hong Kong. In a bit, Hans Goethe would also be joining us from Singapore. But Andrew, good morning. Thank you so much for taking the time out. How have you read into the Fed's statement? There were a couple of changes from the September statement, but nothing too untoward, I thought.
Absolutely. They are very much standing pat on what they said. The economy is strong, unemployment is historically low, earnings are increasing, there are all signs of inflation likely to hit above the 2%, modified, however, by the strength of the US dollar. Therefore, they're going to raise interest rates. Never mind what Trump says. Again, unlike a lot of other central banks, and I'm going to clear my throat here, we're not far away from one of them which is under pressure not to do things. Again, the Fed is going to do exactly what they said they're going to do. Trump can always threaten, but I don't think he would dare interfere bluntly and obviously because he cannot actually remove the chairman of the Fed unless there is a particular judicial process. So leaving the politics aside, Fed on course to raise interest rates once again in December.
The question mark, Andrew, I think that is on the minds of people is there a possibility of a faster trajectory of rate hikes in 2019 because of the data that is coming in from the underlying jobs market? The unemployment rate keeps on dipping and the job markets keep on looking stronger, which means that wage inflation could rise faster than what people currently anticipate.
Well, actually, I never thought that the Fed is going to stop in year 18. In other words, they will put another 25 basis points in around Christmas and then that's stopped. No, I would not be at all surprised, given the existing trends, that they will go for 2 more hikes. In other words, they will add another 50 basis points in the course of the year 19. And the markets, to a great extent, I won't say they have priced that in because markets never price anything in. They react in whichever way the mood takes them. Okay, but there will be no surprises. In other words, if we're having this conversation in February, I will tell you, I will never tell you I told you so, but I will tell you not surprised that they raised again.
Interesting. Let's get in Hans Goethe in this discussion as well, along with Andrew Freris. Hans, good morning to you. I was just looking at the statement and the language, and from the previous statement wherein they mentioned that household spending and growth of business fixed investment have both grown strongly. From there, the statement has changed to their point that the growth of business fixed investment has moderated from its rapid pace earlier in the year. Do you read a lot into this, or is this just a standard statement, according to you?
Well, you could read into it the fact that corporations, instead of spending money on capex, they have bought back their own shares. And I think the trade war would probably even increase that kind of thinking, because it lowers the visibility for corporations. So that's one possibility. But as to Fed policy, I mean, according to Fed Chairman Powell himself, I mean, he said that in early October, that the neutral Fed funds rate is around 3%, and that would suggest further rate hikes. And usually the Fed does not stop at neutral, usually tends to overshoot on the upside. So I think a rate hike in December seems to be a sure thing, and then possibly another 3 in 2019. So the Fed thinks the economy is strong. I'm not so sure about that, to be honest with you, because at some point these rate hikes will have a slowing effect overall, and at the same time we also have a rising inflation, not to forget. So we'll be looking at a little bit of a stagflationary environment, which will put the Fed into a possibly difficult position in 2019.
Hans, what does all of this mean for flows into EMs? Now, we're just looking at the Bloomberg data. After shunning the Indian bond markets for a major part of 2018, FPIs have returned over the last 8 or 9 days. They've pumped in some money into the Indian debt market, maybe because of the falling crude prices and the macros not looking like worsening. But if the Fed stays on course for what is said and doesn't do it more aggressively, is that something that is priced in by the emerging market bond markets?
Well, to some degree it is, but if the Fed really is hell-bent on raising rates above the neutral rate, then I'm not so convinced. I think for now, you had the sell-off in October, and I think there might be some flows back into emerging markets. But, if the Fed keeps raising rates, the dollar will increase, and then in the medium to long term, this is detrimental to emerging markets. I'm not convinced that we're out of the woods yet here.
Interesting. Andrew, what is your view out here? I mean, some flows into Indian debt markets. I don't know what's happening across the Asian region, but what's your thought on fund flows?
There was a mild improvement on the rupee forex rate. In other words, it strengthened, but very, very mildly, because we're still in the 70s. And I'm afraid if I look, and after all, this is Bloomberg, if I look at my Bloomberg screen on the equities side, it's just a sea of red. Practically every single developing and developed market, except for the United States, is year-to-date down. So in other words, we're literally at the end of the year, and if you put some money at the beginning of the year, right now, you would have lost money. Now, in the case of the emerging markets, there are differentiations in terms of losses. In other words, for example, Straits Time, the Malaysian index, to some extent, the Sensex have fallen less than other indexes, such as, for example, China, which was one of the worst performing. So one could have not made money, one could have lost less money by concentrating in some of the smaller markets. But, our business is to tell the clients how to make money, not to lose money. And right now, of course, the answer is if you are on equities, don't add, most definitely. Again, and if you're not on equities, most definitely do go into equities right now. And the differentiation between fixed income is also very, very wide, because the outlook for United States Treasuries has to be bad, okay, given that the Fed is going to increase interest rates. Yields will be going up and prices will be coming down. It's a very awkward place, very awkward place. Sometimes I feel that for the next 3 to 5 months, I wouldn't mind telling my clients to stay in cash, because at least some of the deposit rates in the United States are likely to offer a relatively safer, and I would say fantastic performance, but better than losing money.
Yeah, well, I've heard a few people in India dedicated fund managers also speak that about India in particular. But, the last question on this conversation, and that's to Hans Goethe. Hans, what's your view on India now? The fact that crude has come off quite rapidly as well, and with what the Fed is saying, as things stand, with whatever little you can price in from the US Fed, from oil prices and the macros, are you net bullish on India, or are you neutral on India?
Well, within the context of emerging markets, I think there are some reasons to be bullish on India, at least on a relative basis. First of all, India is a lot less tied into the global supply chain, so a lot less affected by the trade war between the U.S. and China. And crude oil, I think, has corrected enough. There's going to be an OPEC meeting very soon, so I would maybe expect some action there. So I think in terms of crude, yeah, that has been a positive for India. Maybe we could see some kind of either stabilization or an increase, which of course would be a headwind for India. But overall, I would think that given the earnings outlook for India, I think on a relative basis, the Indian market should do okay within an emerging markets context.
Okay. Gentlemen, both of you, thank you so much for taking this early morning call and appreciate your time on Bloomberg Quint today.
Okay.
That's Andrew Freris and Hans Goethe with their thoughts on what the Fed has done and the resultant impact thereof. In fact, the other big change, and the winds have changed again in the stormy oil market as OPEC signaled it will consider returning to output cuts next year. This would be the second production U-turn this year. Bloomberg's Anthony DePaola has more in this report.
Yeah, it is a big U-turn from what the policy had been and what the policy changed to even just a couple months ago, because they went out of cut mode to let's pump all we can mode in order to bring the prices down, appease some of the customers, make the market more confident that there was going to be enough oil. And now we're seeing some forecasts that demand is going to be slower next year than it was this year. We've got concerns over the trade war, other currencies in consumer countries that are not as strong against the dollar, and that's hurting those countries' ability to buy oil. So these fears are causing OPEC to look and say, well, let's not put too much oil on the market. Let's not get ahead of ourselves. We don't want prices crashing. So that's really the impetus for this move.
Well, let's wait and watch. For now, the markets don't show any sign of an improvement or an uptick because of the crude prices, because as I said, the Asian screen has a tick of red. But let's see, maybe it changes with what crude is doing. However, let's move on to the next story, and that is earnings. It's the last leg of the earnings season, and jewelry, watch, and eyewear maker Titan is expected to post a strong set of numbers today. Agam Wakili is standing by with what the markets are pricing in. Morning, Agam.
Morning.
And can Titan see a happy new year?
Yes, it can actually, and I was surprised by the kind of estimates that the Bloomberg mean is throwing up right now, because the last quarter was, well, there were some concerns with respect to growth, and it's turning out that that could just be a one-off, because if you take a look at the expectations, on your screen, we're expecting about 22 to 23% increase in your net sales. Again, your EBITDA could rise 24%. And because of that, your margins should remain stable at around 12.6% against 12.5% year-on-year. Of course, profits are likely to rise by around 20%. Now, when it comes to your jewelry segment, your estimates are all over the place, anywhere between 17 to as much as 30%. But, well, that's the range that we are working in. And, of course, it's going to continue to see an increase in its market share at the expense of the unorganized sector. And that is something that reports have been talking about. When it comes to the studded jewelry segment, that is going to comprise of as much as 35% of your entire jewelry, sales. But moving on, when it comes to its watches segment too, do remember the last couple of quarters, we've seen a little bit of revival coming through. This time around, we are likely to see a 7% like-to-like growth. Do remember, this does not involve the new, stores and the new collection watches, but just the watches which have been into the system for at least a year, and that was likely to see about a 7% growth. It could be perhaps a down quarter for eyewear and other segments. We're still looking at a modest revival, but on the whole, considering the fact that we're likely to see the recovery in jewelry segment, and also that we likely see a continuation of growth in the watches segment, is something that could play out in Titan's favor for this quarter as well, Neeraj.
Okay, let's wait and watch. But Agam, if you were to look at one standout feature for Titan today, one number that you should monitor, which will make either the results go bad or go weak, what would that be?
Certainly the jewelry segment's revenue growth.
Okay, and above what levels would it be favorable and below what levels would it be bad?
Sure. So the range that we are playing with when it comes to jewelry is 17 to 30%. I think if we are likely to see a growth of anywhere between 20 to 25%, it's going to be taken as a positive for the street. However, should we see that number fall to as much as 15%, again, there will be some questions raised on the sustainability of growth in the next couple of quarters as well.
Well, let's wait and watch, and let's wait and watch for the commentary as well from the management. I'm sure Agam Vakil will talk to the management and get us that as well. Agam, thanks for putting that into perspective. Well, let's tighten for you. The only Nifty company to come out with numbers today. A bunch of other mid-sized companies, as I said, in the trade setup are slated to come out today, so important ones to monitor. Keep in mind all those names as well. Well, the last piece on First Word today. And while it's been a buoyant start for Samvat 2075, albeit a short one, when Indian indices posted healthy gains in the Muhurat trading session, it's also important to not get too ahead of oneself and look back at some of the lessons learned since the last Samvat. So 5 nuggets of wisdom that I've picked up through the whole of last year. A copy on this is there on the website as well, but I just thought these 5 kind of stand out for me. And the first one is very, very important as well, considering what's happened in the markets in the recent past. It came in a conversation with Nikhil Vohra at one conference when he said that if we don't have the gumption to take a tough market or a tough investment, we should just leave the market. I think this is very important because a lot of investors, even mutual fund investors or otherwise, would be very disheartened about what's happening in the markets in the recent times and would be questioning about whether it makes sense for them to invest considering the losses that they have seen in the last 3 months. But frankly, if you are investing for the long term, learn to take some of these shots into your stride as well. There is a very interesting learning that I learned through one of the blogs that I was reading, and well, technically you can argue there's no knee-jerk reaction, but the question is that whether you should brace yourself for a correction all the time, because history has shown, and Jeremy Grantham put out this in his note early in January, that more money can be lost in trying to anticipate market corrections than in actual corrections themselves. So don't try and anticipate a correction and stay on the sidelines because you miss out on the entire upside that the market gives you. That, having said that, please play this with caution. But I think this was a very important learning at the start of the year. And boy, people in the S&P 500 found it the hard way. They were waiting for a correction. It didn't come, and the markets really went through the roof. Well, the other bit is something that came in from Kenneth Andrade in his chat on Alpha Moguls, wherein he mentioned a lot of things. But amidst that, what stood out was the summation of his thought, which said that what the volatility enables you to do is correct the mistakes that you've made. So Kenneth was largely speaking on the point that if 2018 has been a year of extreme volatility and low returns, what you got to do is take a hard look at your portfolio and try and figure out where is it that you're making mistakes. And if you made those mistakes, then correct those mistakes, because this volatility will not give you too much of returns. So you won't have to buy necessarily for the next 1 month or the next 3 months. Correct your mistakes and build your portfolio for the returns that will come in arguably in 2019 or 2020. So use the volatility as your friend. Don't get disheartened by it. Nilesh Shah of Envision Capital, when he spoke to us in April or thereabouts, made a very important point about how cash is everything. He says, and I quote, that free cash flows and ratios like price to cash flow would serve investors better because over a period of time, markets, according to him, would disproportionately reward growing cash flows. So essentially, while everybody looks at debt to equity, PE ratios and a lot of other factors, Nilesh believed that if you look at cash flows and if there are companies that you invest in which have got this moat of cash flows building up over a period of the next few years, then the markets would disproportionately reward those companies. Keep in mind, IT companies are a fine example out there. The Mindtrees and some of the other mid-sized companies growing at 10, 11, 12%, getting ME multiples of 20%. Now, why is this happening? Because they are cash generation machines. No debt, high cash generation, possibilities of buyback, dividends being paid. Market loves these things. So do keep in mind that there is merit in the argument that cash is something that you got to attach a lot of importance to. The last piece that came in was from Vijay Kedia. Again, he spoke to us sometime earlier this year. Patience is a virtue. I think that's the summation. But I think Vijay made a very important point that for an individual investor, once he's invested in the stocks that he's invested in, he has to learn to do nothing. Don't try and do things every single day. I think the larger point that Vijay was trying to make in this point was, and if you see that discussion as well, you'll figure out that Vijay Kedia is saying that unlike a fund manager who gets these continuous flow of money and therefore is under pressure to deploy that money, an individual investor is not having this continuous flow of money. So he doesn't have to take an investing decision every single day. Let's assume you zero down on a stock and you put the money in the stock. That's it. You then don't have to figure out what you'll do the next day because you don't have the money to put in. You don't have to sell a stock in order to buy a new one. Once you've invested, and if you're convinced that the investment is a good investment, learn to do nothing. I thought it was a very vital point that came in from Vijay Kedia in that discussion, amongst the many other things that he spoke about. There are lots more. In fact, there are 10 investing nuggets that, frankly, I've picked up over the course of the last Samvat, and you can log on to the website and try and read up that story as well. It's filed on the Bloomberg Quint website, 10 things that I've learned since last Diwali. Nevertheless, that's all that we have on First Word today. I hope all of us become better investors in the new Samvat. One attempt to do that is get you some great market voices. And in today on IndianOpen, we discussed the investment strategy for Samvat 2075 with Bharat Shah of ASK Group. We talk about the business outlook with Arun Jain of Intellect Design Arena. It's amongst the top performing stocks in the Nifty 500 YTD or the Samvat gone by. And then take a health check of the pharma sector with Deepak Malik of Edelweiss Financial Services. But after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Quint Live.
Completing 100 years of building beneficial relationships with our customers and stakeholders. Union Bank of India celebrates its 100th Foundation Day and wishes all viewers a very happy Diwali.
Good news, got a promotion and a damn good raise.
Congrats, beta.
वाह, raise? अब तो insurance policy ले ले.
कौन सी कंपनी चुनूं?
Choose वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture a billion.
Welcome back. You're watching Indian Open right here on Bloomberg. Quick glance at what's been happening in Asia, and nothing much. But for the fact that we're down closer to about 0.5% across the board for indices like the Nikkei 225, Shanghai and Hang Seng, which is trading under by more than 1.5%, 1.8% given lower. SGX Nifty trading down by 0.25%. Not much happening over the week as well. The Mahura trading session, nonetheless, was definitely more optimistic, about 0.5% plus in just 1.5 hours of trade. But let's see whether there's a carry-through of that happens in today's session, considering the setup. Futures an option, and that's an important aspect to have a look at. We've got Agam joining in right now to take us through what's passing in the derivative space. Good morning, Agam.
Good morning, Devina. So it was a very short session. We really didn't have too much going on, but when it comes to the futures, and at least as far as the Nifty is concerned, where very little action or very little increase in open interest, but the Nifty banking futures did see about an uptick of around 1.5% in OI. But moving on, let's take a look at some of your other variables. The India VIX specifically, in this case, did decline by around 3.4%, but you know, it's been largely range bound between 17 and 20 over the previous few days, and it's going to be in focus considering your option premiums. When it comes to your change in open interest, what we actually saw was a little more writing around the 10,600 mark, considering we saw the Nifty advance, and also unwinding, consequently, of around the 10,700 calls. So watch out for that. However, we still do have a lot of accumulation in the 10,700 call, and that will serve as a near-term resistance on the upside. Moving on, taking a look at your put call ratio, that has remained largely unchanged on the Nifty at around 1.59. But when it comes to your stocks, I'm keeping an eye on, several others, but, Infibeam will be one, considering we have seen that increase of around 14% in its underlying accumulation towards longs. Bharti Industries is the other one, which is considerably weak and has been over the previous few sessions. It declined with more accumulation in open interest. But moving against the tide, we have Apollo Tyres in the same industry, which actually advanced. So we saw some gains of around 3.5% and accumulation in open interest of as much as 2.6%. So we're seeing fresh longs in Apollo Tyres. We're likely to see mixed cues in today's day of trade, considering the indication of the SGX Nifty, and it's likely to be a quiet day, considering it has been a truncated week. So we'll be watching out for some of these cues as we move into trade today.
Okay, Agam, thanks for putting that into perspective. Do watch out for some of these cues for our markets as well. It'll be interesting to see what happens to banks, because frankly, when I was looking at the data for what we did from the last summer to this summer, it was very noticeable that amongst the top 10 gainers, there was an ICICI Bank, there was an Axis Bank, there was no HDFC, there was no Kotak, there was no IndusInd Bank. It doesn't happen too often in a period when the markets are looking for stability and in a volatile market that you don't have the HDFCs and the Kotaks, but you actually have the IDFC Bank, ICICI banks and the Axis banks coming up. And frankly, if you just look at the 3-month comparison chart for ICICI Bank versus the Nifty, ICICI Bank, I think, has had double-digit gains over the last 3 months. Yeah. And the Nifty in the same period has actually corrected about 6 or 7%. Yeah. So net to net, ICICI Bank versus the index has actually given, this is ICICI Bank, a 3-month return of about 7 or 8% versus the Nifty falling, I would presume, in the ensuing 3 months. So there is at least, 7.5. So there is about a 15% net correction or a positive return thrown up by ICICI Bank versus the index and versus some of the other banking names. That's quite a stellar statistic.
In most conversations, Neeraj, ICICI actually stands apart for most of our experts as well, because they believe the story for ICICI is here to stay and probably see just an accelerated growth for the bank going forward. So if at all one uses an opportunity to enter into the financial space in a volatile market, I mean, that stands to be one of the better names to put your money in.
Yeah, actually, maybe the valuation is in favor of ICICI Bank as well. And I think ICICI Bank and SBI are amongst the two names that people have said in the corporate-facing banking scenario, which might actually do well. So let's wait and watch.
Well, we'll get on to talking about all of these stocks with our guests as well. But in the meantime, let's go across to our research team. They're all standing by to run us through what's been happening over these holidays and what kind of numbers have come out and what are the stocks in news. So we've got Nikki, we've got Yash and Agam. I'll start off with you, Nikki.
Yeah.
You're talking on week numbers?
No, I'm going to be talking about a bunch of news that we're tracking this morning. I'm going to be starting off with slew of numbers, actually, the numbers that we're not tracking. I'm going to be talking about Dredging Corp, where the cabinet has approved the divestment target of the entire stake of 73%, and Bharti Airtel, which Moody's has placed the rating, current rating of Baa3 under the review for downgrade on account of cash flow concern. Emphasis, the company is going to be acquiring US-based intelligence system for $25 million. Tata Steel is also expected to be in focus, given that Thyssen Group has warned about the profit. It says that the net income of $0.1 billion expected is expected to be adversely impacted by cartel proceeding. The Thyssen Group has also cut the EBIT guidance to euro 1.6 billion from euro 1.8 due to production and shipping concerns in the fourth quarter. Punjab National Bank, where Government of India has increased stake in the bank by more than 5.5% and thereby increased its shareholding to around 72%. And also we're tracking in JSW Steel, where the October production is up as much as 8% to a number of 14.47 lakh tons versus 13.43 that we have seen in the same month the last year.
All right, Nikki. So those are some stocks and news to watch out for. Let's go across and find out which companies posted good set of numbers. Yes.
Yeah, I'll start with Aditya Birla Capital, and they came out with a good set of numbers. Revenues have grown by about 33% on a year-on-year basis, coming in at about 3,600 crore rupees. A premium income rose by 39% to 1,657 crore rupees, along with a 30% growth in their lending book, which came in at about 58,000 crore rupees. Manappuram Finance is the next one, with a 19% growth in net interest income. Net profit saw a 39% growth, coming in at about 222 crore rupees, and strong growth seen in its microfinance segment, which rose by about 45%. The last company I want to highlight is Camlin Fine Sciences. Revenues have grown by about 38% to 201 crores. A net profit in this quarter as against a net loss in the same quarter last year, and EBITDA margins of 8.5% versus 2.7 in the same quarter last year. So strong numbers coming in from Camlin Fine Sciences as well.
Okay, Yash, thanks a lot for that. Agam, the poor set of numbers?
Right, so I have three on my radar. We have, let's start off with MRF, because we've seen revenues grow 9%, but along with that, we've also seen margins come off quite substantially to 14.8% against 16.9%. And again, profits consequently declined by around 12.3%. So we're expecting some weakness to come through when it comes to MRF. Aban Offshore, well, disappointing top line growth, down 33%. We've also seen the net loss widen to around 38 crores against a net loss of 28 crores year on year. And do remember, this is despite the fact that we've seen other income at around 64 crores against 74 crores. And finally, coming down to Pricol, while revenues did rise 16%, its profit was down 59%, owing to the fact that there was weakness in margins, which came off by as much as 200 basis points to around 7.7% against 9.7%. So those are just some of the other stocks that we are watching out in trade on the back of weak earnings.
All right. Agam, thanks a lot for that. Those are some stocks that came out, the companies that came out with poor set of numbers. Let's bring in Devain Choksi of KR Choksi Securities. He's joining us right now on the phone line. Devain, thanks very much for taking out the time. We've entered into the new year post Diwali. I mean, what's the sentiment according to you, and how do you think you're going to be positioning yourself?
Yeah, good morning. Yes, I think the Samvat year 2075 is starting on a promising note. On the one side, I think we have had, a significant amount of carnage taking place in last 2 months due to withdrawal of money. And that I think largely because of the threat of rupee falling against the dollar, since the dollar index was strengthening. Now, with the equation changing in favor of the crude oil importing countries, and the crude oil prices are going down, along with that, the dollar index is also, I think, likely to go down from what I think it was. So, frankly, both crude and the currency, both of them are going to provide a great amount of reprieve to emerging markets, and particularly countries like India. From that perspective, if I see it, I think the threat of withdrawal, I think, by the ETF is subsiding. At the same time, domestic market investors have remained quite resilient to this fall, and I think has been adding into the equity in this particular period. So I think all in all put together, I feel that I think the November-December months should be largely stable months as far as the markets are concerned. And probably we should see back on the corporate earning growth, which we have seen in this quarter. I think the market should be giving a steady set of performance going forward in these 2 months.
Devin, one group of stocks that came into focus this Diwali, and not just on the technical side, but on the fundamental side, was most of these specialty chemical companies. And one name, Deepak Nitrite, is something that majority of them liked. Is it something that one can look at from an investment perspective?
Well, it's a good stock, commodity space, expanding the capacity, getting into the larger amount of clarity as far as the business is concerned. And I think the company should be showing relatively better performance as far as I think the growth aspect is concerned. So certainly, I think the company would be in a little better position. The threat here is only one, and as I see it, I think is the fluctuation in the commodity prices. If the fluctuation in the commodity prices, I think, becomes uncontrollable, then probably I think some of these companies may not show the kind of result that is basically expected of them. As of now, for Deepak Nitrite, I think the view remains positive. I don't know, I think, about majority of the specialty chemical companies. I think they may have some situation in which I think they might have to look at the cost of commodities, I think, before we buy into them.
There have been a few other factors. Crude oil now in a bear market situation, at least the WTI crude under by 20% in a matter of 1 month. However, the equity markets have probably not seen the same amount or the same pace of, a comeback as what we would have seen when crude oil started to actually move up. And on the other hand, the currency itself is still perched itself pretty firmly at 73. So these variables not moving much. How are you reading into it?
So frankly, I think there are two factors which are affecting the equity market currently. One, people have lost, I think, significant amount of money in last 2 months because those who played on leverage position, they were found caught on the wrong foot. And as a result of which, I think their portfolio had incurred significant amount of loss. And I'm maintaining the people who have been playing on the leverage, I think they were the victims of this situation. Since they were playing on the leverage, I think most of the loan against shares providing companies, the financial companies and NBFCs, also withdrew their extended lending to them. And as a result of which, I think they were forced selling this particular stock. They are not likely to come back in a hurry, largely because I think the loan against share kind of a product, probably I think most of the financial companies would take time before they bring in with a force. So I would think that I think that's the reason for which I think the markets, equity markets are not moving in tandem with the other variables which are improving. However, at the same time, I believe that because of the improvement in the other variables, the less amount of, I think, stress on the headwinds, as I may want to call it as, could possibly help, I think, the genuine investors come back into the market and buy selectively into their portfolios.
Devin, good morning. Neeraj here, and thanks from my end as well for taking on the time and speaking to us this morning. A couple of news bits, Devin, that have come in. Just wanted your opinion here. ThyssenKrupp has cut the adjusted EBIT guidance as well. They expect the net income affected by cartel proceedings as well. How do you read into this development?
Good morning, Neeraj. For sure, I think you are going to find such kind of situation wherein the commodity players will have their own share of problems continuing. As I was mentioning for the chemical commodities, I think this could be true for even the other metal commodities and some of the industrial commodities as well. So we'll have to be really watchful because I think this kind of volatility in the crude oil is not something which is very good for any company. And as a result of which, I think one will have to watch some of these businesses very carefully. Because in near future, I think the company's performance might get affected and they may not live up to the guidance that they have given. So that's a worry which I am carrying as far as the commodity-related businesses are concerned.
What did you read too much into this possibilities of a rating downgrade by Moody's on Airtel?
That's a good question, Neeraj. Honestly speaking, I think it's something which we'll have to study a little bit more in detail. I don't know how exactly I'll respond. But in all, I must say that the business per se itself is passing through a very challenging time. And every balance sheet is, I think, quite debt-ridden. Plus, I think they are going into the capex mode. So for the requirement of money, rating agencies will have to be cautious and give the cautious guidance. I would think so.
Interesting. Devin, one question on Dredging Corp as well. That's a stock that is arguably one of the most important ones in news. The cabinet has approved the sale of the entire 73.47% stake of the government. more importantly, I know this stock got fancy about a couple of years ago when this whole Clean Ganga, etc. projects came into play, and everybody started saying that the order book will be full and you go out and buy. It's been a big disappointment, and on top of that, you have an announcement that the entire government stake would be sold off at some point of time. What should a minority investor who's holding stake in Dredging Corporation do post this?
Well, again, I think, as I always put it, that I think any business which is connected with infrastructure has the biggest problem of a lot of uncertainties in form of, I think, clearances, etc. This company, I think, is relatively promising, though. But at the same time, I think what level of government's less interference would be in every subject, I think, is not that something which I understand. And as a result of which, I think even though they hold promises, I think they can't deliver. My own take is that I think till the time you get company-specific clarity about the projects that they are winning and executing, I think it would be just futile to, I think, buy them only on the potential. So I think a lot of study will have to be done. As a matter of fact, I think we somehow or other, I think, don't like, I think, many of the government companies because of the consistency part is not there. Even if whatever we try, even whatever the management says about the business and the consistency, somewhere those variables which are not in control of anybody, I think, starts affecting the business of the company. As a result of which, we try and keep ourselves a little away from that particular space.
Got that. Devin, we'll leave it at that. Really appreciate you joining us this morning and sharing your thoughts on the show with us.
Thank you.
All right, Indian equities began somewhat at 2075 by clocking in their best Diwali gains in a decade after nearly wiping out the yearly gains on concerns of high crude oil prices and a weaker rupee. As Indian stocks enter the new trading year, which are the pockets of opportunities? Take a look at what these market veterans have to say.
The markets beat to its own drum. We like to think that, elections come, market will fall. That doesn't typically happen. We had a very sharp break in the market, as you know, in September, October, 15% fall. So the question that must occupy investors, was this a break in a bull market or a bull market topping out? And the evidence so far suggests that it's just a break in the bull market. So obviously the index and individual stocks will probably head higher over the next Samvat.
Sure. There is a debate between running a diversified portfolio at this point in time against a concentrated one. Where would you stand here?
It's a very esoteric question that people do PhDs on. I happen to prefer a diversified portfolio, but the people who know their businesses prefer a concentrated portfolio. So there's no right answer. It depends on what style works for you, the amount of money you manage, for whom you're managing it. If it helps you, I run a fairly diversified portfolio. The top 10 stocks must be 50%, but then the discipline breaks down.
Right. This is the money. We also had the returns conclude in the United States. If you keep that aside, what are the other global cues that you're keeping an eye on that could perhaps impact global markets and perhaps India?
The two things that are obvious are, of course, if oil prices again become buoyant, they've been under pressure, which has helped us tremendously. And obviously, if there's some big crack in the Dow, I think a regular crack we can handle. Those are the two major factors. And the thing, we need to get back our own confidence after the recent NBFC problems. We need to get confident about our markets. And I think that repair takes time. So hopefully we will repair.
Some of these global businesses like casinos and perhaps liquor, which have made into India. Where do you stand on some of these?
I mean, those are some stocks that have fallen in this fall, and they look like good bets to make. So I think these are themes that I would be attracted to over the next 5-10 years, because they're great businesses, they're impregnable businesses. There's some great franchises out there. So whether it's in gaming or whether it's in liquor, whether it's in some consumption space, those stocks still look quite attractive to me.
There's also the question of elections this year. Can that cause some volatility? Are you expecting that to happen?
That election is always a very questionable issue.
Right.
One doesn't know the Indian people how they will turn out. So, but I think on the whole, the Modi has done a good job. That in the last 4 years, they have done excellent things. And demonetization, then GST, all these things are, I think, should put positive in the mind of the voters.
Right. Mr. Choksi, there is a question about whether or not you want to stay with the tried and tested names in the markets, or would you want to go ahead and venture out and perhaps take a little more risk with the relatively smaller names? How would you go about it, and what are you asking your clients to do?
Basically, my philosophy is that I first look at the industry, which industry is doing well.
Okay.
And out of that, I will identify a company which is good, that is, and management is first thing.
Right.
And financial and the growth of the company you have to see. But today the management plays a very big role. And I think I am rather going for a small company. I would like to remain with a mid-size or a large company because they can withstand the adverse circumstances.
Okay, Mr. Choksi, then I have to ask you, what stocks are you recommending to your clients right now?
Basically, today we are recommending Deepak Nitrate number 1.
Okay.
Then Nosil is second number. Then third one is JK Paper. Paper industry is doing very well.
Right.
So JK Paper is there. Commercial vehicle, Jamna Auto is looking very good.
Okay, that's of course two veterans, and Mr. K.R. Choksi speaking about stocks like Nosil, Deepak Nitrite, if I'm not wrong, and one more which I'm forgetting, but essentially bent towards the specialty chemical space for sure from the veteran investor himself. Okay, now let's talk about some charts. It's a start to the new Samvat trading. We're likely to start off about a third of a percent lower if the SGX Nifty is indicating that, but we're likely to start off circa 10,600 for our markets. Let's get in Shrikant Chouhan, Senior Vice President of Technical Research at Kotak Securities, with us, joining us on the show. Shrikant, good having you. Thanks so much for joining it. Good morning. Happy New Year. What is your trading position for the day today, Shrikant?
Good morning. I think, see, the way the markets are moving up, and it is very clear that the markets are going up gradually. It is not in that same pace as it was like when the market was around 10,000, and from there all the way to went to 10,700. So this time the pace is much slower, much gradual, and that is why we are of the view that between 10,650, 10,750 we have to be cautious, because there are around above those levels there are multiple resistance which will arrest the market at higher levels. On the downside, 10,550, 560 is going to act as a very good support for the market. And the way since last 2-3 days the market is closing above this level, we are of the view that it is heading for the levels of maybe 10,650, 670. So 10,550 acted as a very good support in this whole year. And the great rally that we saw from 10,550 to 11,770, the base was also around 10,550. So 10,550 is going to act as a very good support for next couple of weeks, couple of months, and in case if we drop below that, then it is going to act as a resistance. For trading strategies, we are going to focus on large cap companies. HDFC looks good, which is around 1820, 1850 levels. There we are of the view that it is heading for the levels of 1860, 1875 on the higher side, and here we can keep stop loss at 1790. The other stock which we like is from very small cap, that is CG Power, which is around 3620, 3650, and the formation is quite interesting. It is forming positive divergence sort of formation, and it is very similar to Adani Power, which was when the Adani Power was around 24-25 levels. So it looks good. CG Power, it is heading for the levels of at least 39, 39.5 in next 1 or 2 days of time, and here we can keep stop loss at 35.90.
All right, just stay on with us, Shrikant. We'll come back to you and talk a little bit more, since you've already mentioned your stock strategies, some more ideas from you as well. But in the meantime, let's go across to Yashpal, who is standing by for a special segment, Bloomberg Edge, where he tells us about a pattern that the Bloomberg terminal has thrown up on his stock, or a trend that he has spotted. So Yash, what's it going to be today?
Good morning, Devina. The stock today is actually GRU Finance, and there is a sell call coming in with the indicator being the stochastic indicator. Let's first try and understand what it is. It is basically a momentum oscillator, and it shows the relationship between the current price relative to the highest highs and lowest lows, and helps identify overextended price moves. 80 indicates an overbought level, and 20 indicates an oversold. A crossover indicates a buy or a sell. Now in this case, let's get the chart up. In the case of GRU Finance, the indicator has turned negative with the blue line over here, which is the stochastic line that has crossed below the white line, indicating an early sell signal. Now we've seen that the stock has corrected significantly, going from the levels of 340 to as low as 250. A bit of a bounce seen here, but 300 has been a key resistance level, and that is where we are seeing some amount of selling pressure coming in for the stock.
All right, and how accurate is this?
over the last 1 year, if you went short every time the indicator turned bearish, it would have given you a positive return of about 8%.
Got that. Thanks a lot for that, Yash. Appreciate it. Shrikant, just coming on one stock, not during summer trading, but the day before that, on the back of some news, NMDC was the one that cracked heavily in trade, but it's still trading closer to its 200-day moving average. Would you take a trade in this stock?
Yeah, Devin, are you asking about ONGC, correct?
Sorry? NMDC.
Is it about ONGC?
NMDC at 113.
NMDC, okay. Fine, correct. Yeah, so NMDC specifically, see, like all these metal companies, they are trading in a specific range. They are not able to cross their previous highs, but at the same time, they are also not falling. So I think they are not going up, maybe because of fall in crude prices, and maybe they are not cracking badly is because of the way Indian markets are shaping up. I think they are going to spend some more time between this range, and NMDC specifically, which was around 113, 114 levels, is having very strong support close to 105, 106. So again, here also it's an interesting formation, and there also we feel that it is heading for the levels of 124, 125, but that's the next major barrier for it, and from current levels we can expect 124, 125 on the higher side, and here we can keep stop loss somewhere close to 107, 108. So it's a positional trade that we should look for, and we can expect 124, 125 on the higher side. But we also like Tata Steel and Vedanta, which are very close to their important support areas, and we are expecting some uptake in next few weeks.
Would you trade the oil marketing companies today, Shrikant, because of the crude price fall?
See, the way all these Neeraj oil companies and oil refining companies are reversing from their lower levels, and the way they are holding at highs, one thing is very clear, that they are anticipating that the crude is going to trade somewhere close to 70, 65 for next couple of weeks or months. HPCL looks really good, and if you go through with its formation on monthly basis, it's an interesting formation because the stock has completed fall of 13 months, and after 13 months the stock reversed sharply. So all indicators are clearly indicating us that the stock is heading for at least 270, 275. But because of there is like lack of interest and uncertainty about crude prices, the stock was not performing. But maybe after this specific decline from 72 to 69, I think now it is going to move higher. So we like HPCL and we also like BPCL. So yes, if there are like any trade specific trades, if there is opening very close to its previous close, then we should look for adding long position in all oil refining companies.
Okay, stay on, Shrikant. Let's get in Samvat Sarkar, who joins in with the top brokerage calls for the morning as well, and maybe some of these stocks could react. Samvat, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have a CLSA on Voltas. So the brokerage has maintained its sell rating on the stock, but has cut down the target price on Voltas to 465 from 480. Now, according to the brokerage, Voltas reported a weak second quarter earnings led by the biggest fall in its AC margins in the last 6 years. Now, aggressive pricing to clear inventories in a weak market, warranties, commodity and foreign exchange losses impacted the AC margins in the second quarter of financial year 2019 for Voltas. Now, some of this weakness was offset by good execution seen in the project business of the company. However, the brokerage believes that a stock like Voltas is trading at an expensive valuation is not ready for such weak earnings, and that is the reason why the shares have been underperforming the market in the last 6 months. Now, second we have is Hsbc on Finnick Mills. Now, the brokerage has maintained its buy rating on the stock and has hiked the target price on Finnick Mills to 800 rupees from 770. Now, according to the brokerage, the Q2 earnings of Finnick Mills were operationally sound as its rental income and consumption from malls grew strongly. Now, with 5 new malls coming up and existing malls growing strongly, the brokerage is expecting the company's rental income to grow at a compounded annual growth rate of 16.7% over the next 5 years. Lastly, in the residential segment, the brokerage says that the company has recorded an uptick in its sales momentum, but the numbers are still below their estimates.
All right. Thanks, Amit, for that. We've got closer to a minute left for pre-open.
Yeah, but interesting, Phoenix Mills.
Yeah.
I think Rahul from Nirmal Bang was discussing this on Diwali Day. The results looked fairly positive. EBITDA margins expanded for a business like that, which is very sticky, for margins to expand as well. They're doing a few things right.
Yeah. Let's see whether or not those target prices can be achieved on the stock. Nonetheless, in the last 1 month, the stock has given you returns of closer to 17%. 38 odd seconds left to go for market pre-open. Just quickly hop across to Asia once again to see if anything is worsened, to change it out there. And it looks like Hang Seng seems to have dipped a little bit more. So more than 2% cut coming in for the Hang Seng. You've got the Nikkei 225, which is just about stagnant at those levels. And so is Shanghai. For SGX Nifty, we're still down about 0.25% or so. So the setup at this juncture is not looking all that promising, but nonetheless, it has been a truncated week. Today is a Friday. We're going to be hoping for a good weekly close as well in today's session. Last week we had a bumper session, a bumper week, closer to about 5.5%. That's market pre-open on your screens right now. About 0.1% higher on the Nifty, and the Sensex, which is up about 0.5%. Taking a look at some of the stocks then and quickly pulling them up on your screens in pre-open trade. You've got the likes of a Bajaj Finserv, which is showing you a heavy uptick. HPCL is also up about 3.66%, or Trek Cement 2.5% higher, M&M 2% higher, Asian Paints 1.9% higher. Eicher Motors gains, Tech Mahindra gains 1.2% there. HDFC Limited, ICICI Bank, JSW Steel, all gaining closer to 1% apiece. Among stocks losing out, Bharti Airtel, that's a big one there, but nonetheless, it's an initial pricing tick on the stock to 10% lower. And there you have it, 7% already now. Moody's, putting the stock under review for maybe a downgrade there on the counter. HDFC Bank, Power Grid, Bajaj Auto are some of the other losers in trade.
Something's happening with some of the PSUs. Dredging Corporation is a stock in news, and that 10% uptick out there. I don't know if it'll last or no, frankly. But the likes of Linde India, ITI in particular, is up for the second day on a trot now, so doing rather well. The gaining list, at least in the pre-open session, is filled with stocks which you wouldn't normally go out and bet on. The likes of Quality, Vakrangi, 8K Miles. These are the names that are really stacking up. Infibeam is up another 10%. It's really not the list of stocks that you want to bet your last penny on, but all of them are up and about. Shipping Corp has some gains to itself. Spark has this unnatural 20% uptick. I think it'll change. Some result reactions, maybe Manappuram General Finance, and let's see if that is trading marginally positively or no. About a couple of percentage points higher. Some fund infusion as well that could happen into this company. What's not doing well? Ahead of results, Sobha marginally lower. There is weakness in Repco Home Finance and the real estate players. It's not just Sobha, DB Realty and a few others too. Looking like they'll start off slightly lower. Just lastly, bring up the aviation counters and see if they are ever reacting so marginally to the crude price cut. So Interglobe Aviation, Jet Airways, SpiceJet should come up on your screen. Could there be marginal upticks? Let's wait and watch. 970 for an Interglobe Aviation, nudging closer to the 1,000 mark yet again. And SpiceJet about 1% higher in trade. Well, just very briefly, the currency and the bond yield, 72.71 versus 73 as of close the other day. The crude price fall, I reckon, also plays some part here, and the fact that FPIs have been buying into the Indian debt market. So all of that should augur well for the currency. The bond yield should come up on your screen as well. Is there some more cooling off of the yields? Well, 7.76 currently, not so much, but from those levels of 7.9, we're now to 7.76. This is not a bad tick. Nooresh Mirani, Head of Technical Research at AMSEC, with us on the show. Nooresh, good having you. Thanks so much for joining in. Best wishes for a new year. How are you approaching trade today, Nooresh? For the near term, let's start off with that first.
So for the near term, we are bullish on the Nifty till the time we keep on holding about 10,480 to 520 and say a target price closer to 10,700 on the upside. And specifically on the stock side, the interesting stocks are REC Limited and PFC. Both the stocks have given a breakout out of a sideways range. So looking at REC towards a target price of 130 and a stop loss at 116. Similarly, PFC would be a target price of 105 to 110 and a stop loss at 94. And both the stocks have, after being in a long-term downtrend, have finally started showing signs of a turnaround and a trend change.
Yeah, sorry, finish your point.
Yeah, and the third one is LIC Housing, which is again showing a strong bottoming out signal wherein it has made a double bottom around 400, 410. So looking towards a reversal towards 460 on that one.
Nooresh, just want your thought on the Nifty. You mentioned that you're bullish till we hold a particular level. At about 10,610 to 10,620, Would you go out and buy the Nifty today, the October series or the November series? Excuse me.
Yeah. Today, closer to 10,560 to 580 would be a good risk-reward entry point.
Okay, that's a good entry point there, even if you have to take the trade today around these levels. Deepak Jasani is also joining in right now. Deepak, good morning to you. Thanks very much for taking out the time and speaking with us this morning. What are you advising clients right now in terms of what kind of a strategy do they adopt? Whether it's prudent to probably even sit on some cash right now?
Good morning. The markets are on an uptrend, a temporary uptrend as it were. Probably it will last for another 1 or 2 weeks. So what we have been advising our clients is to sort of participate in this trading opportunity and at higher levels be ready to sort of raise some cash, especially in stocks that have not risen in this move to the extent expected. So probably the laggards as it were. So these are the two broad strategies that we think the client should be adopting.
If you have to narrow it down to a specific sector or a pocket, which would those be?
See, as far as sectors are concerned, we are quite comfortable with the BFSI segment because that is one of the high beta sectors and it has also beaten down quite a bit. So apart from that, we like IT services, we like pharma, we like cement to some extent and also metals. So these are the sectors which we broadly like, and sectors which we want to avoid are basically power, realty, FMCG to an extent because of the valuation concerns, and telecom.
Deepak, one pocket which suddenly has started to garner a lot of interest is the cap goods space with a slight bias towards infrastructure. So would you be looking at counters in that pocket?
Capital goods, basically, we don't have too many stocks apart from 2 or 3 MNCs and one L&T, which is a conglomerate. So in that sense, the choice available is very limited. But yes, all said and done, capital goods seems to be a space where the downside seems limited and the upsides could be gradual from here.
Deepak, good morning and thanks so much for joining in. The OMCs, is the crude price fall yet another cue for people to make a fresh investment in oil marketing companies, or would you shy away?
Again, I would say they should take it as a trading bet because now 2 or 3 things. One is that crude prices should sustain at these lower levels for at least a few months. Only then they will get the full benefit out of it. In case the crude prices fall and then again start to rise, then they will be doubly hit in the sense that they will have face inventory losses on the one hand, and the other hand they will continue to be in the same soup as they are. So there should be some sustainability of the crude price at the lower levels, and the December quarter results, we don't know as to where the crude prices will ultimately end up at the end of December. So till that time, I think we should one should try and trade from a short-term perspective in these stocks.
Shrikant, Chouhan, coming on the PSU stocks today, I mean, and particular lot that I'm giving you, Dredging Corporation is up 9.5%, ITI is up 9.5%, Shipping Corporation is up about 8.5%. I saw an ITDC which is up about 3.5% higher. How about the charts looking of any of these? Would you trade them?
See, the way they have fallen badly on the back of like a delay or cancellation of this divestment process, I think now on the back of this particular specific news flow, we are going to see strong up move in stocks like Dredging, Container Corporation, or maybe even Bharat Earthmover. We also like ITI. Specifically for Dredging Corporation, which was around 350, was like around 950, 900 levels when there was news flow that they are going to sell, government is going to sell strategic stake in that particular company. That time the stock was like doing much better and it was above all important breakout levels. After like this particular news flow, the stock has fallen badly, but now I'm of the view that even if there is a 10%, 7% higher opening from current levels, it's an opportunity for positional traders to take some long positions, because if they start retracing to their immediate fall, then also we can see the levels of 450 or maybe 470 on the high side from Dredging Corporation. For Bharat Earthmover, we are of the view that it is heading for the levels of at least 850, 870. And for ITI, it is like continuously and holding very good around 70 levels. So the next level to watch out for is between 110 to 115. So all these three companies are really doing well on charts, and they have like fallen badly, and the bounce back is also showing better strength. One more stock which is outperforming in this space is Container Corporation, and it recovered sharply when there was like fall in the overall PSUs. So specifically, if like really somebody want to focus, then Container Corporation looks much better than these three companies. But at the same time, if really somebody want to take a positional call in the market for these PSUs, then they can buy even at this price.
Well, this is turning out like we suspected it would. The Nifty 50 at the end of the pre-open session is showing a mild tick of green. So 10,614 or thereabouts. Remember, we had a holiday yesterday while Asia was doing well, plus crude has fallen. So, well, marginal tick of green while the rest of the Asian pack has a tick of red. But minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Let's begin with earnings. Titan will be the only Nifty company to report numbers today. The list of non-index names which are important include the likes of Amara Raja Batteries, India Cements, as well as Shankara Building Products.
Among companies that reported strong results over the holiday period includes the likes of Aditya Birla Capital, Manappuram Finance and Camlin Fine Sciences.
On the other hand, a disappointing quarter for MRF, Aban Offshore, as well as Precor.
Bharti Airtel will be in focus today. Ratings agency Moody's has placed its current Baa3 rating on review for a downgrade. It has cited weak cash generations and high leverage as reasons for the same.
More bad news for Fortis Healthcare. The company's CEO Bhavdeep Singh has resigned from his post. However, he will continue in his current capacity till the board finalizes his succession plan.
And lastly, JSW Steel's crude steel production rose 8% to 14.47 lakh tons in the month of October.
Well, I guess the stock, which is the most important one to talk about, is Bharti Airtel. Deepak Jasani, how have you read into this news? The weak cash flows and the debt positions, well known. Moody's has now placed it under review for a possible downgrade. The stock looking like it will start off about 5% lower. But what's the fundamental thesis here?
Yeah, as we discussed earlier, telecom is one space which we are not comfortable at this point of time. Basically, the new entrant over the last 2 years has created a lot of disruption in the market, and a lot of capex outflows and spectrum fees need to be paid out by these companies. They don't have the pricing power to raise tariffs at this point of time, so they will continue to be in trouble, and we will like to sort of stay away from this till the competitive intensity reduces. Plus, in this company's case, there is some issue at the Tanzanian subsidiary also, which is a minor thing. But when the chips are down, even minor negatives will come to the fore.
All right, that's Bharti Airtel. Watch out for that stock in intraday trade. Nooresh, come to you on the charts for Bharti Airtel, and then if you could probably throw some light on Tata Motors and the swell run that's had from the levels of 160.
So if we look at Bharti Airtel over the last, say, few weeks as well as almost the last few years, irrespective of all the bad news, the stock has not broken down below 275, 280. So till the point we continue to hold above those levels, it is a signal of finding support here. So maybe a risky bet would be to buy closer to 285 and a stop loss at 275.
Reliance Industries, Nooresh?
Reliance Industries.
Yeah.
Yeah. So if you look at Reliance Industries, it has made a double bottom around closer to 1020, 1030. The trend is up and we could head up towards 1180 levels in the short term, and closer to 1075 to 1090 is a support zone where one can look towards a buy.
Deepak Jasani, 30 seconds, but if I can ask you for what would have been or what was the pick of the week from HDFC this time around, something that people can put fresh money in, but a quick 30-second answer, please.
Yeah, we had come out with a buy on Automotive Axles. Basically, the company is into auto ancillary, mainly axles, front and rear axles. It's a joint venture between Meritor and Kalyani Group. So likely to do well, available at decent valuations, has corrected quite a bit from the highs. And there is visibility of revenue and profit growth.
All right, 1 minute left to go for market opening. Let's get in the top calls from our technical analysts. Let's start off with you first, Nooresh. Quick 20-second answer.
would be a buy on REC with a target price of 130 and a stop loss at 115.
All right, what about you, Shrikant?
I would like to go with CG Power, which is around 3640, 3620. Stock is forming positive divergence as well as reversal formation on daily basis. With a stop loss at 3590, we should look for adding CG Power with a target of 39.
Nooresh, would you take a quick bet on, would you take a bet on Nifty Bank today?
Not really on the bank Nifty, would prefer Nifty as such.
Okay, so Nifty is the call, and Nooresh has already mentioned that comfortable buying it at about 10,560 to 580. I think Shrikant's bets too were broadly around that range, and some stock specific ideas already on your given by our experts. Stay on, gentlemen. Just taking opening thoughts from you post market open. But here's how we are starting off the first day of the new Samvat, so to say. I mean, Murat trading session notwithstanding. We'll start off marginally higher, in fact, or maybe just about flattish in the session today. And we are starting off flattish. The Nifty Bank is down 0.5%, but the Sensex about 1/3%. So, well, the pre-open session was deceptive because we are starting off in line with what the SGX was indicating and in line with what the Asian counterparts are doing as well. So, a tick of red, but nothing too alarming as yet. I think individual stocks would be in focus, and maybe a Bharti Airtel would be well pulled up on the screen. And let's see. Okay, the mid caps and the small caps very, very flattish, but individual stocks in focus. Maybe the heat map or maybe individual common points. Bharti Airtel about 3.5 to 4% lower, 293 and counting. So that one under a bit of cloud. Tata Steel, I reckon, would be under a bit of cloud today. So should start off marginally negative today, if I'm not wrong. Yes, about 0.8%. And on the flip side, frankly, stocks worth talking about. The heat map will come up on your screen, and you will see that all marketing companies right up there on the list of gainers. So BP, HP, IOC right out there. Top 3 names all doing well. Bharti Infratel marginally higher. Asian Paints marginally higher, I would reckon, again because of the crude sentiment, but more red than green on the screen. HDFC, other loser, which is down about 1.5%. IT, well, Infosys and a bit of cloud, but Bharti Airtel and OMCs at two divergent ends, and those are the ones that are in focus. Before I hand it over to Devina, just 2 or 3 pockets that I want to highlight individually based on news or otherwise. Now, the stake sale approved. The entire government stake sale approved by the cabinet, and the stock dredging corporations 7.5% higher in trade, which I reckon has led to the other PSU stocks doing well too. So dredging corporation is one, but ITI, Shipping Corporation of India, ITDC, all of them start off on a positive note in the session today. One brief check on crude beneficiaries, HPCL, Berger Paints, SpiceJet, and all of them start off marginally higher in trade. Berger Paints about 1.5%, SpiceJet 1.5%, HPBP, IOC, all of them northwards of 1%. What are you spotting, Devina?
Reactions, let's see if they've actually happened. So the likes of an Aditya Birla Capital, net profit is down about 12% at 197 crores. Stocks down about 1.8%. Manappuram Finance, not a bad quarter. The net profits rose by 39%, but flattish for the price move. And Camlin Fine Sciences reported a profit of 1.3 crores, was a loss of 4 crores last time around, and that one is doing okay for itself. Aside from that, a lot of action in stock like Infibeam, difficult stock to take a call on. Linde is up about 9% as well. We've already spoken about the PSU a lot. Bajaj Hindustan being one stock which is doing okay for itself this morning, closed at 5% higher. JBF Industries is up 4.5%. But Rampochini, Sri Lanka Sugar. So once again, it's the sugar stocks that are all active in trade today. Interglobe Aviation up 2.5%. Deepak Fertilizers, that's also up as well. Bharti Infratel, that's doing okay for itself. It's up about 1.9%. EID Parry, Deepak Fertilizers, Allahabad Bank are some of the other gainers in trade this morning. A quick look at Greenply, the stock's trading high by about 1.4% in the session this morning. Amongst some of the losers, PVR is down 4%, 8K Miles is down 3.5%, PC Jewelers is down 3%, Thomas Cook and Indian Overseas Bank and KPIT Tech loses by about 2% in the session.
Well, quick opening thoughts before we thank our guests. Nooresh, to you first. 10,561, this is around the levels that you may have been comfortable, but just the brisk downtick on open, would you revise your call or would you buy the Nifty at the current levels?
It would be a buy at current levels with a stop loss at 520.
Wow, Nooresh is very confident about this call on the index. Shrikant, anything that pops up on your screen on the index or on specific movers?
I think stock specific, if you see, then these private banks are doing well. IndianOpen Bank especially, which opened higher, as well as along with other crude beneficiaries. Asian Paint looks good, which is opening of the stock is much better than the expectations. So there, like we should look for taking some short-term bets. Asian Paints, which was like trading around 1250, 1260, is now trading around 1270. And if you just go through with its overall long-term pattern, then the stock is very close to its 50 DMA, and it is on the verge of breaking that. So on the dismissal of that 50 DMA, we are going to see some more upside. Currently, it is around 1265. We are of the view that we should look for adding stock even at this price. We can expect 1300, 1320 on the higher side. And for other companies, I think IndianOpen Bank looks good. There, I think the stock is forming some inverse head and shoulder sort of formation, and some more upside is also not ruled out.
Okay, Jain, Nooresh as well as Shrikant, thanks so much for joining in and giving us that perspective. Deepak, you want to explain in detail the automotive axle news, because I'd curtail your time horizon then, but what are the target prices, what are the valuation levels at those target prices?
So basically, the rationale as far as auto axle is concerned is that the Indian CV market is on an upswing. The implementation of Bharat 6 emission control norms will trigger a pre-buying in FY20. General elections in 2019 will increase economic activity and demand for CVs, and expansion and value-added products will aid revenue and margin growth. There are some concerns in the sense that it is exposed to the CV cycles. There are client concentration risk. There could be delays in ramping up of new products and competition from global MNCs. So now here we have the targets as 1320 and 1475, which are 13 and 14 and a half times FY20 EPS. So that's the target. I also have a disclosure: whatever stocks we have discussed, my relatives and my company does not own any of those shares.
All right, Deepak Jasani, thank you so very much for joining us. Appreciate you taking out the time. And while we are speaking, the Nifty is down closer to 1/3% at 10,562. Not doing much right now, 35 points given up. But let's hear out another important voice. Bharat Shah of ASK Group believes that equities is the best asset class for long-term wealth creation. He's also happy with the current turmoil because, in his words, it differentiates the men from the boys and provides for more future discipline. I began this conversation by asking him about investing in equities. Listen.
No other asset class can create long-term value of the kind that equity as an asset class can and does. And that is because investing in equity is nothing but owning businesses. And ultimately, as we all know, that it is only the businesses which create greatest economic value. Owning fixed deposits of the banks don't make you wealthy. They just can give you given limited returns. Real estate, at the end of the day, is an article of consumption, a factor of cost of production, and therefore returns cannot exceed that of the returns created by the business. And the other asset, which is gold or the bullion, is not even in any asset class in any meaningful definition. So equity is the only asset class which can create not only outsize potential to create value, but on a long-term basis, far sustainable basis. But investing in equity is not an automatic thing. Markets have no duty to make you wealthy simply because you have put some money to work in the markets. You still have a duty to pick and choose well, select the good businesses, ensure that these are run by people of integrity and competence. You need to ensure that the business has characteristics which can create economic value, and you have to be disciplined and buy these quality franchises at sensible prices, and thereafter having the wisdom to stay the course. So all of these are duties imposed upon investor before he can expect to make those meaningful returns which are embedded, potentially inherent in equity as an asset class. So it's not an automatic. that you put money into the equity markets and that's a get rich quick kind of a scheme. It is not. So investors have work to do, and those who are either intellectually lazy or unwilling to really do what are the required tenets for good investing, the results can't be gratifying.
Yeah. All right. So since we now know that equities as an asset class is the place to be, Mr. Shah, you've been a veteran investor yourself. Does the current market standing and the environment that we are in bother you a little bit? I mean, obviously from a long-term point of view, these will just be events that will come and go. But does it present an opportunity, or do you still see more risks?
No, the current events don't bother me a wee bit. If you invest in markets, you must know that the volatility and violence is an alter ego of markets. Not necessarily high amount of violence of the kind that you saw in 2008-9 when markets were torn asunder, but a 15-20% kind of a drop in the markets is something which you should routinely expect every few years, and there is nothing very surprising about it, nothing particularly rabid about it. And volatility in any case on a normal basis would always be there in equity. It was there in the past, it is there today, and it will remain in future. So if you are frightened about volatility, you can't be into the markets, that's for sure. But once you understand that markets are less of weighing machine behavior in the short run and more like voting machine in that short run, but over a long run it behaves more like weighing machine, then you realize actually the beauty and the power of the markets. That the best way to tame the beast is by being disciplined yourself, because otherwise you let the indiscipline of market to become your own indiscipline. So markets on a temporary basis, time to time, will behave in a violent, volatile, unreasonable, exaggerated way. All kinds of things are possible. But over a period of time, markets are calm, serene, quiet, well behaved, and most importantly, whatever may be the gap between price and the real value of a business at a point of time, over a period of time, price and value invariably are brought together by the magic wand of the markets, and we have to have faith and confidence in that. We must have capability to judge business by business, company by company, the real value of the business, which is both art and science, and having judged the real value of the business with calm and clear confidence, we have to be invested for long run at a sensible price, at some margin of safety, some discount to the value, and then having wisdom to stay the course. But if we do that, the rewards are plentiful. So this kind of sometimes the volatility comes in form of oil price, sometimes it could be trade conflict between US and maybe China or more parts of the world, sometimes it comes in form of default by ILFS in CP markets. These events come and go. I don't think we should get carried away or worried too much, because overall broad fundamentals remain solid, compliant, quality businesses. The prices have come down, but the fundamentals, their earnings, their capability remain completely intact. And therefore, I would say this is a fantastic opportunity to buy quality franchises at fair prices.
Right. So in light of that, would you use this volatility and the correction as an opportunity then to get into the equity markets if you were shy of getting in at higher valuations? And also from a slightly more longer term perspective, are you bullish on the India growth story, be it from an earnings point of view, be it from an equity market point of view, and be it from the point of view of the economic growth itself? Well,
the answer to the first question is clearly yes. That of course this is, to me, it looks like as good a time as ever. If I have to quote Buffett, even after my 30 years of investing, I feel like a kid in a candy shop today. That is the kind of opportunities that I see in the markets. There are a lot of negative naysayers around, a lot of people who get worried by day-to-day events. There are a lot of people who are worried about and will make meaningful noises about this problem and that problem. But I think equity is art of seeing a possible opportunity rather than seeing constant threats. And I see far more opportunities rather than challenges. So the answer to the first question is yes. As far as the second part is concerned, in terms of the longer term picture, the broad fundamentals of the economy remain solid. Even if we look at macro numbers, by and large I find the picture gratifying. Inflation is reasonable. I'm fairly confident that the fiscal deficit would be at the targeted level of about 3.3 that is out in the budget. Even current account deficit at 2.5% odd is something which is reasonable given the oil price situation that we've gone through. And I think quality firms, quality businesses are reporting very, very robust numbers. Unfortunately, in the media when these data comes out, they had apple, oranges, lemon, cherry, melon, everything put together and come up with an average to arrive at a description of what is happening to the market, and which is fundamentally a very bad and poor way of looking at markets, because those kind of aggregates hide a lot of meaningful reality behind it. What I am seeing actually is that in virtually all the sectors, in the quality businesses, compliant businesses, straightforward managements, company after company, we are seeing fantastic performance by those businesses, barring a couple of them having produced numbers which are little less than what we expected. By and large, of all the results declared so far, we have been pretty comfortable in terms of the kind of performance rolled out by the firms. So I would go by the reality as we see in the businesses rather than hear too much of opinion dished out in various forms of media. Because when we listen to these opinions in the media, we think we are seeing one kind of world. When we go and check out with the companies and businesses, we find we seem to be in some other world. And therefore, the opportunity that we see is based on what we think at a ground level exists. So I remain very comfortable, and I believe prices have corrected and are reasonable. Good businesses are getting better. Their performance has been rock solid, and if you are able to disregard the sentimental backlash that the markets produce when markets are not exactly very conducive, that is exactly the best time when you can make easily good returns by just buying good companies at a sensible price and remaining there, which is what I see today. And on a more longer term basis, I believe probably the best decade for India, its economy and its quality and compliant businesses, probably the best decade ahead is going to be now. That's what I personally strongly believe.
Mr. Shah, your take on the current turmoil in the NBFC space, and how have you read into the situation?
I think it is a very good thing that has happened. Lot of NBFCs have been indisciplined. Many of them have poor quality assets. Many of them were reckless to have improper asset liability match. Many of them were in anxiety to grow, were lending at rates which were not sensible, and in any case many of them were lending to poor quality borrowers, and therefore time to time rude reminders like these sorts out the boys from the men, and and therefore all that has happened in the NBFC and some of the concerns that the firms are going through is actually healthy and good for the quality firms, disciplined firms, firms which understand that lending, it is easy to lend, but the real work happens only when you have recovered what you have lent. And therefore the quality firms are disciplined in the lending rates, in the client profile, in the way they go about it, in their leveraging, and in managing their overall operations in a tight, proper fashion, which is what a lending business is all about. And therefore all that has happened will eventually ensure a greater hygiene, strength, and actually greater respect and regard for better behaved, disciplined, quality NBFCs. So all what has happened, in my opinion, is very good.
Is that an investment category that people should look into now?
We have done it in the past, we have done it today, and we'll look forward to doing that in future.
Right. One last question, Mr. Shah, before I wrap this up. While you've been talking about using opportunities and using the market volatility and dips like this as an opportunity to start, building up the portfolio, which direction or which areas to focus on right now? Probably areas which are under-owned so far and have growth potential, or areas which are over-owned but the valuations were lofty and now they've started to come off. So which segments are you focusing on?
I think more from a bottom-up stock picking point of view, but having said that, clearly consumption, both durables, non-durables, is a fantastic opportunity. In $2.5 trillion GDP last year, almost 1.6 trillion was consumption, which is nothing. Only when this consumption from 1.6 will become 5, 8, 10, 12, that I'll probably start reflecting whether there is any further scope for it to grow. Till then, I think in my opinion, on a long run, there is a free highway there. On the banks, quality NBFC, quality insurance firms, again, there is a great long-term opportunity. Finance sector in general is a force multiplier. It usually grows at a multiple of GDP growth rate, and typically the growth rate of finance precedes that of the economy. And therefore, it always remains a very attractive and major area. But we have to act with discipline and find the right quality businesses run by quality managements. So NBFCs, quality banks, and the quality insurance firms, all of them represent great opportunity. Similarly, in automobile, auto parts, automobile, we have a critical ecosystem, whether we take two-wheelers, scooters, bikes, commercial vehicle, three-wheelers, cars. We are among the top largest to anywhere within first 5 ranks in the world in each of these categories, and therefore we have a great critical mass both from a domestic market as well as international opportunity. Along with that, auto parts opportunity, which again is a significant one. Agriculture related, where important fundamental changes are brewing around, and over a period of next 5 to 10 years will witness more important significant changes. Therefore, quality agriculture dependent businesses will do wonderfully well. So these are some areas, but as I said, we don't invest based on economic macros. I don't think that global macros can have an unduly major impact beyond a point. It is not even buying of the themes or sectors. It is at the end of the day buying individual business for its merits or lack of it.
Got that. Mr. Shah, it was a pleasure chatting with you, sir. Thanks very much for joining us. Appreciate you taking out the time and sharing your thoughts with us here on the show.
Thank you very much, David.
Completing 100 years of building beneficial relationships with our customers and stakeholders. Union Bank of India celebrates its 100th Foundation Day and wishes all viewers a very happy Diwali.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, बट पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back. You're with us here on Bloomberg Quint. Well, the last few months have been rewarding for Intellect design arena, with the financial technology company bagging 4 big-ticket contracts in the second quarter. The markets have also rewarded this stock, but have these new orders set the bar too high for the company in the coming quarters? Let's ask Arun, Jain, Chairman and Managing Director of the company. But the peg here obviously is not just the business. It's also about how the stock has performed from last Samvat to this Samvat, which has been almost double in terms of a stock price return. Mr. Jain, thanks very much for taking out the time and speaking to us. Obviously, things are going great at the company, and we've seen that in terms of the numbers over the last 5 quarters. We've seen the collections go up, which means alternatively the reduction of the cash burn at your end. What's the outlook for? Like, will you be able to maintain this performance in the coming few quarters?
Yeah, let me just take, thank you very much for inviting me for the talk to the investor. I think we are a new company on the block which is focused on financial technology products. So it's a fintech product company which we enable the large banks globally. So in last 3.5 years of our listing as an independent company and focus on investment of over 1,000 crore into the company, it started delivering the result what we are expected to. Our run rate has moved from 600 crore annually to now 1,500 crore annually. So I think that's a big satisfaction from an Indian product company perspective. We are able to get 62% revenue from advanced market compared to the local market. Most of the Indian companies takes revenue from the domestic market, but 62% share of the revenue is substantially large number more than what we had initially when we started the company. So I think our strategies are working well as of now. And looking at in product business, we have 14 products for the investor. Out of 14 products, 4 products are now at a stage 4 of the development and ready for stage 5. Stage 5 is when partners start selling your products. That is the stage 5 of it. So 4 products reaching the international benchmark where there is a high license revenue. Our license revenue last year, in last 6 months, grown over 86%, which is again a benchmark and lead indicator for product company, because those are measured by the license revenue. So as of now, things are looking good to grow. We designed the company for 20% growth year on year. We are expecting in dollar terms. We grew 42% in this quarter, but for annualized basis, we designed initially 20% on dollar terms, but because of advantage of rupee, we could be able to get a better returns on the growth numbers. But now, looking at the numbers, we are looking 25% growth in dollar terms will be possible in the current year. And looking at last 3.5 years CAGR, we are growing close to 23% CAGR in last 3 years. And I think these are all the indexes which are working in the right direction right now.
All right, so 25% in terms of dollar revenue growth is what you anticipate. So I want to go back to your previous your answer and talk about the 4 products have reached monetization stage. In the near term, foreseeable future, how many more products do you see, reaching the monetization stage, and also your strategy to start selling more to your existing client base, because that's probably a focus area for a company like yourself.
That's right. So both the levers are available to us. First, the 4 products now which reach monetization stage, we have got 21 lives. They start growing at a faster pace. The growth rate of these 4 products could go up to above 40% year on year, these 4 products. Then second dimension is every year our focus is to bring 2 more products into the maturity stage of monetization stage. So out of 14 products, next year if you have 6 products to be there, that is the next point. And third is with the existing base of over 200 clients, how do we do the cross-sell? So these are 3 levers available, which gives us a confidence of continuous growth over the next 3 to 4 years. We don't see any shortage of the market space. We may be constrained on the capacity, which we have enhanced last quarter by hiring another 200 additional people, because it takes 6 to 9 months for us to develop specialist people in the product business.
So my point being, if you have to do that, you're currently spending about 25% of your revenues in sales and marketing. If you have to achieve that next level, will this increase considerably?
I think 25% is now stabilized over the period of time. In the last 1.5 years, it's getting stabilized at 25%. So 25% sales and marketing is what we are comfortable with, because with our growth in the revenue, this budget will automatically increase.
Mr. Jain, what's the nature of deal wins that you envisage which will help you clock in this 20-25% growth for the next 3 years? Would the deal sizes increase over the course of the next 12 to 18 months?
Yeah, if you observe our license revenue growth in first half year is 162 crore, last quarter is 109 crore in single quarter. I think this license is a critical metrics which we are looking at it. Typically, we used to price our license around $10 lakh to $15 lakh. Now our price band has moved up to $30 lakh to $60 lakh. So I think that's the price band of the license which is driving us the bigger size deals. And second thing is, in the deal itself, our license quantum is 50% of the total deal value, and 50% is implementation. Earlier it used to be 1/3 license and 2/3 implementation. Because of maturity of the product, our implementation comes smaller than the license, and we can get higher money for license, and license gets us a next 10-year benefit, because we have AMC of 20% on the license over the life cycle of the product.
Would this mean higher margins? And do you envisage that over the next 3 years you can progress to the next bucket of operating profit margin bands or EBITDA margin bands? What's the forecast?
Substantially, I think that's the right thing. If you look at FlexCube, Oracle Financial Services, what margin they are enjoying today, over 30-35% margins, are just because of the efforts which they put in 2006, 2007. Because once per company is mature, the margins are in the range of 30%, over 30% in next 3 to 5 years.
So where would you move your margins to, say, in the next 3 years, Mr. Jain?
I will not able to give you an exact number, but I think that's a kind of a number I'm saying. It could be about 20% margins can be definitely be there in next 3 years' time.
Okay. Just one small issue. I mean, we're just looking at a report, and the range of bad debts provision, which historically I believe was about 10 to 20 million per quarter, but in second quarter there was a provision of about $95 million because there were bad debts for 4 Indian PSU banks. Is this a clear and present danger for you as a company? And will the business model mean that you will have these provisions being volatile over the course of the next 3 years?
Okay, so it's good that you raised this point. It's not $95 million, it's 95 million rupees, first of all.
Okay.
So it's a
excuse me, yeah, 95 million rupees, yeah.
Yeah, so 95 million rupees, and this is a change in the strategy. When we are looking for monetization and industrialization phase or Intellect, we are looking those clients which are not able to enjoy the expertise of Intellect and some of the. So it's more of a cleaning up cycle time where this number is coming in. So this number we don't expect to go up or to continue.
All right. So on an aggregate basis, what would your provision rate be? Will it be this $10-20 million only?
Rupees. That's right.
Sorry, rupees.
Typically, we provide 2 million rupees. We provide 20 million rupees. We provide 2 crore. We provide every quarter, and that's continuing from last almost 12 quarters. And those are sufficient for us to manage.
All right. Let's shift focus in terms of your deal pipeline and focus areas for you. You've signed large deals in the UK and the largest ever deal with a Singapore-based bank in the quarter gone by. How are you expecting to gain traction, and which geography are you focusing on more?
I think there's a huge scope of digital and contextual. So our position of investment was to make enterprise solutions for the banking, which are completely digital, microservices-based, AI-based solutions. And there's a huge market where legacy modernization is required. So a lot of banks in Europe, advanced market, have not invested sufficient money. After 2008-2009 crisis, they stopped investing in technologies and they are lagging behind a lot of Asian counterparts. And that's where the significant amount of money is getting invested. So that's a focus area which is we are looking at it. That advanced market now is 62%, because advanced market comes with a higher margin and longevity of the deal and the higher pricing. So all the three factors gets. So Singapore, UK, Canada, Australia. We won 2 deals in Australia last quarter, and then US. And then after that, we are going to Spain and some of the Nordic countries where we are looking our focus at.
All right, Mr. Jain, we'll leave it at that. Thank you very much for joining us. Appreciate you taking out the time and highlighting, your future trajectory in terms of growth and what exactly lies the potential for the company. So management pretty optimistic about the growth potential in the
FY19 25%, FY20 maybe maintaining the historical growth rates, which were CAGR of about 23%, and the margins moving to a higher bucket as well. For now, the management seems confident. Maybe that's what the market has rewarded it for, about 100% return from last Samvat to this Samvat, currently trading flat in the session. But the last 12 months have been spectacular for Intellect Design Arena. Okay, the next space, and the last 12 months have been reasonably good for the export-oriented sectors as well, IT and pharma. Now, the pharmaceutical sector, while it's had tough in the year thus far, the last 3 months have been reasonably okay. September quarter results demonstrate the competitive and regulatory pressures weighing in some of the drug makers as well. But according to an Edelweiss note, the worst may be behind for the industry, with the domestic market recovering and companies saying that price erosion in the US is slowing down. How soon can we expect this turnaround, and when will it start showing in for investors as well? Let's ask these questions to Deepak Malik. He's Senior Analyst at Edelweiss Financial Services. Joins us right now on the show. Deepak, good having you. Thanks much for joining in, and wish you and your team a very happy new year. Do you think it'll be a happy new year for the pharma companies?
Yeah, thanks, Neeraj, and happy Diwali and happy new year.
Thank you.
Yeah, so last few years were very tough for the pharma industry, especially in India, and mainly because of the increase in competition and pricing pressures. So last year was very tough for all of them. In fact, the profits have almost half for all these companies who are exporting to US. But start of the year, I think, is better than the last few years, and mainly because of one, we have seen the currency has depreciated by almost 15%. So it's a good tailwind which will support the profitability. So that is one. And the second thing, pricing pressure, which was in double digit for the last 1 or 2 years. So this year, and especially in this quarter, most of the pharma companies are saying that the ACE has gone to single digits, 7 to 8% kind of pricing pressure. So that is another good news. And third thing, the concentration and the regulatory risk both have also come down considerably. If you see start of the year, Sun Pharma cleared its Halol plant, and last year Cadila cleared the inspection very successfully. Aurobindo also did it fine. So only Dr. Reddy and Lupin are left in terms of clearing this, and I think by the end of this year they should also be able to clear the regulatory issues. So that also one risk is now waning. So these are some of the positive news, but there are still some challenges which are there in the US market. One, the pricing pressure is still there. 7-8% is higher than the long-term average of 4-5%. Second, the faster approvals by the US FDA, which is also not stopping and which is leading to further more competition. And third, the Indian pharma companies are now spending more on the R&D, more in the investments, and as a result, the pressure on the profitability, which also will continue to remain because most of them are trying to enter into complex and specialty bucket, and where the investments are high and the gestation period is long. So it's a mixed bag, but nonetheless things are improving and worse seems to be over.
Interesting. Deepak, you would have looked at these cycles in the past as well. In your annual report analysis on the sector, you've spoken about how the rising business costs, waning returns on capital, and the cash flows have turned negative. Net debt has surged 50%. Do all of these turn around very, very quickly in the case of an upcycle if we indeed see one, because of the two factors that you mentioned, the currency and the easing of pricing pressures? Can these factors turn around very, very quickly?
So whenever the business cycle changes, so it's always a very slow process. It doesn't change it very quickly. But with these initial signs, so companies then becomes confident, and as the approvals of their complex basket will start, I think then that is the time you will see significant growth in the numbers, and then one can say that yes, the cycle has turned. I think we have to wait a little more time, maybe by the end of this year or by the start of the next year, when we will start seeing some meaningful approvals for these companies, and at that point of time we can say that yes, cycle has turned significantly.
Deepak, good morning to you. Just want to come in on whether or not, if you are bifurcating a company like Biocon, which is more focused on its biosimilar business, versus some of the other pure generics businesses, does that differentiator mark a big change from the way you're looking at the company and the potential of the company thereof?
Yeah, so if you see in the next 5 years, the total patent expiry in the US will be around $100 billion. And in that, around 40% will be in the biologic space. So around $40 to $45 billion worth of patents are expiring in the biosimilar space. And in this space, most of the Indian companies, especially these generic companies, are not participating in the wave 1 and wave 2 because they are still waiting and watching how the market will evolve. Whereas the Biocon, if you see, is among those very few companies who are going to participate in the first wave of approvals in the US market, and with its partner called Mylan. So that is the differentiating factor between Biocon and rest of the generic companies.
So does it tilt you more towards Biocon? Does your bias become more positive towards Biocon?
So yes, they have the first mover advantage. So, but with the first mover advantage, not only the opportunity comes, but also the risk comes in, because this is in one unknown area. We don't know how the market will pan out and how faster the market will open up for the biosimilars. Second thing, we don't know what kind of pricing erosions and market shares for the generic companies or the biosimilar companies will be coming in. And third and very important factor is that these companies are competing with the innovator companies like Pfizer, Amgen, Lilly. Those are the ones who are coming into biosimilar space. So yes, at first instance, Biocon is the first one to enter into this space. But then second is there are certain unknown things which will get to know only as we will progress. So it's too early to say that how things will shape up. I think it's going to be very challenging area. It's not going to be very smooth run for any biosimilar company to become successful in the US market.
Right. Deepak, one last question before we let you go, and that is on Cipla and the quarterly performance that came off from Cipla thereof and the outlook projected by the management.
Come again, I didn't get the question.
On Cipla.
Yeah.
Look, on the numbers and the outlook from the management.
Yeah. So Cipla results were weak this quarter, and large part of the reason was the exports, where 1/3 of the business comes from the tender market, and in tender market we have seen there are challenges in terms of financing. So global funds are not putting up the money, so the number of cases of malaria are going down, and so in ARV and in malaria everywhere there are challenges. Some of the countries have moved out of those tenders, like Kenya and Nigeria. So all the companies who are based out of India, like Ajanta or Cipla or Ipca, Strides, all of them are seeing some pressure in their tender business. And that is what we have seen in this current quarter results of Cipla also, and as a result management has toned down its expectation for the rest of the year. And second, in the domestic market, because of the high base and GST impact in the previous quarter, so we've seen subdued numbers in the domestic market. So as a result, overall numbers were weak, and that is what management also guided for.
All right, Deepak, we'll leave it at that. Thank you very much for joining us and sharing your perspective on the pharma space with us.
Thanks.
So that's the Edelweiss call on the pharma space. But the markets, Neeraj, at this point, not doing much at all. In fact, pretty much perched around those levels that we had at opening.
Yeah, Bharti Airtel, the top loser. Steel companies, JSW and Tata Steel looking marginally off. And on the gaining side, the oil marketing companies, HPCL is the top gainer, by the way, buoyed no doubt by the news of crude prices coming off. Aside of that, it's a quiet day of trade. Watch out for the PSU stocks at the broader end of the spectrum. The dredging corps, ITIs of the world, they are really setting the stage on fire. Linde India is up about 16% in trade as well. But with that, it's a wrap on this leg of Indian Open from Devina and me and the team that put this show together. Thanks so much for watching.